Hello financial fans, welcome back to another stock analysis. Today we'll be covering Illinois Tool Works stock ticker ITW. Illinois Tool Works Incorporated is an American multinational company that designs, manufactures, and sells industrial products and equipment. The company operates in several diverse business segments including automotive, original equipment manufacture, food equipment, construction products, polymers and fluids, and weldings, among others. ITW's products are used in a variety of industries including automotive, construction, food service, and packaging sectors. The company is committed to innovation and regularly invests in research and developments to create new products and improve existing ones. With a global network of operations, ITW serves customers in more than 60 countries and is recognized as a leader in its industry. They currently are sitting at a $75.8 billion market cap, and in 2022 they generated a revenue of $15.9 billion. They currently have a dividend yield of 2.16%, and they are a dividend king with their 52 years of consecutive dividend increases. 19% of their revenue comes from the automotive sector, 15% from the food equipment, 16% from test and measurement, 13% from construction goods, 13% from specialty, 12% from welding, and 12% from polymers and fluid, which is currently not visible on the graph, sadly. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. And we'll be using a standard margin of safety of 25%, and that margin of safety can never be below 0%. The margin of safety will either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we're going to look at are the EBIT growth and the margin growth. The EBIT has gone up, going from $2.5 billion in 2013 to $3.8 billion in 2022. The average EBIT growth during this period was 5.2%, meaning no change in the margin of safety. The margin, however, has also increased, going from 17.8% in 2013 to almost 24% in 2022. The average margin growth hereby was 3.4%, meaning a 5% deduction from a margin of safety. The next two metrics are the dividend growth and the payout ratio. As we've heard before, the Illinois Tool Works is currently a dividend king, and they've increased their dividends for many years. That can be seen in this chart, seeing as the dividends went from $1.44 a share annually in 2011 to $5.24 a share annually in 2022. The average growth in dividends during this period was a very nice 12.7% annual growth rate average in dividends. It says a 5% deduction from a margin of safety, but it's actually a 10% deduction in margin of safety, as you can see on the scale. The payout ratio is sitting at a very nice 51.8%, meaning no change in the margin of safety on this metric. The final metrics that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Illinois Tool Works, this is 1.5 years. In this case, 151% debt to EBITDA ratio, meaning no change in the margin of safety. The return on invested capital is sitting at a very nice 24.7%, meaning a 5% deduction from a margin of safety. Let's go look at the valuation models next to determine the intrinsic value of ITW. First valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in free cash flow annually during this period was 6.5%, and I'm projecting a growth rate of 5% in the next 10 years. With this percentage, we determine the future free cash flow of ITW and determine a terminal year valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This leaves us with a sum of free cash flow of $46.5 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $40.2 billion. And to get our discounted cash flow price per share, we have to divide it by the amount of shares outstanding, leaving us with a discounted cash flow price per share of $130.85. And with the current price of $246.73, we get a very big downside of $115.88, which is almost a 47% downside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts going from 4 years ago to the current year. The average growth rate in dividends annually during this period was almost 7%, and I'm projecting an expected growth rate in the future in dividends of 6.5%. We'll also once again be using a discount rate of 8.5%, and with this we get a discounted dividend model price per share of $279.03, and with the current price of $246.73, we get an upside of $32.30, which is a 13% upside out of this model. The third model is Graham's revised valuation formula. In this model, we look at the earnings per share that ITW is generating, the growth rate estimate that Wall Street is projecting, and the current yield of AAA corporate bonds. And we also look at the PE ratio of a company that has no growth. This is what Benjamin Graham has projected and has set in his valuation formula. This leaves us with a very low valuation, or fair value, as you might say, of $119.97. This is a downside of $126.76, which is a 51.38% downside. The fourth model is the multiple valuation. In this model, we'll be looking at similar companies to ITW, look at their stock price and their earnings per share to determine the average PE multiple in the industry, which in this case is 30.26. All the stuff to do to get our fair value here is to multiply by the earnings per share that ITW is generating, which is $9.77 a share, which leaves us with a fair value of $295.69, which is almost a 20% upside. Final model that we use is the mean reversion theory. This theory will always go by the fact that a company will always trade above or below its mean. And in this case, we look at two metrics, which is the dividend yield and the PE ratio. In this case, we look at, for example, the dividend yield of the past 5 years and get an average from this, which in this case is 2.11%. The current dividend yield is 2.12%, meaning it's trading pretty much right at its mean. With the PE ratio, however, the average PE over the last 5 years was 23.21, and the current PE is 28.17, meaning it's more expensive currently than it was on average in the last 5 years. That's why we get a downside of this model of 8.5%, which is $21 downside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we have imported discounted cash flow, the discounted dividend, Graham's valuation, multiple valuation, and the mean reversion theory prices per share, leaving us with an average of $210.25. We have determined our margin of safety earlier using a standard margin of safety of 25%, deducting it by 5% for the margin growth, deducting it by 5% for the return on invested capital, and by another 10% for the dividend growth, leaving us with a margin of safety of 5%. Applying this margin of safety, we get a fair value of $199.74, and with the current price of $246.73, we get a downside of 19%. Since this company is a dividend king, it might more so be a hold, since you're looking to hold this on for a long period. But that is something you will have to determine for yourself. If there are any other dividend companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.